People always ask me, Warren, what's the secret? How did you build Berkshire Hathaway? How do you pick investments? What's your strategy? And the truth is, there's no single secret. There's no magic formula. But there are strategies, proven strategies that have worked for me over 75 years of investing. Today, I'm going to share with you the 9 most popular investment portfolio strategies that actually work. Not theory, not speculation, real strategies backed by decades of real results. These are the same principles I've used to build one of the most successful investment companies in history. And if you apply them correctly, they can transform your financial future too. Now, before we dive deep into these strategies, if you're serious about building wealth and making smarter investment decisions, make sure you like this video and subscribe to the Trading Man channel. We bring you proven investment wisdom that can genuinely change your financial life. Let's get started with the first strategy. Strategy number 1, value investing the foundation. The first and most fundamental strategy is value investing. This is the bedrock of everything I do. Everything. Value investing is simple to understand, but hard to practice. Here's the core principle. You buy stocks when they're trading for less than their intrinsic value, less than what they're actually worth. Think of it like going to a store and finding a dollar bill selling for 50 cents. You'd buy it, right? That's value investing. But how do you determine intrinsic value? That's where the work comes in. You look at the company's earnings, its cash flows, its assets, its competitive position, its management quality. You analyze everything and figure out what the business is truly worth. Then you wait. You wait patiently until the market price drops below that intrinsic value. Maybe the market panics. Maybe there's temporary bad news. Maybe the company is out of favor. That's when you buy, when others are fearful, when prices are depressed, when you're getting real value for your money. This is how I bought American Express in the 1960s during the salad oil scandal. Everyone was panicking. The stock crashed. But I looked at the fundamentals, the brand, the business model, the competitive advantage, and realized the core business was still incredibly valuable. I bought aggressively when others were selling in fear. And that investment made Berkshire Hathaway hundreds of millions of dollars. Value investing requires patience. It requires discipline. It requires the courage to buy when others are scared and to wait when others are greedy. But it works. Over and over again. It's the single most reliable strategy for building wealth in the stock market. The key is this. Price is what you pay. Value is what you get. Always focus on value, not price. Strategy number 2, economic moat investing. The second strategy is what I call economic moat investing. This is absolutely critical to long-term success. An economic moat is a sustainable competitive advantage that protects a business from competition. Just like a moat around a castle protects it from invaders. When I look at a company, I'm not just looking at current earnings. I'm looking at whether those earnings can be sustained and grown over decades, and that requires a moat. There are several types of economic moats. Brand power, think Coca-Cola. People pay more for Coke than generic cola. That brand is a moat. It creates pricing power and customer loyalty that competitors can't easily replicate. Network effects. Think credit cards like American Express or Visa. The more merchants accept the card, the more valuable it is to consumers. The more consumers use it, the more merchants want to accept it. That's a powerful, self-reinforcing moat. Cost advantages. Think Geico in insurance. We have lower operating costs than competitors, which lets us offer lower prices and still make good profits. Competitors can't easily replicate our cost structure. Switching costs. Think about business software or banking relationships. Once a company integrates software into their operations, switching to a competitor is expensive and disruptive. That creates a moat. Regulatory advantages. Utilities and some other businesses operate in regulated environments that limit competition. That can be a moat if managed well. When I invest, I'm looking for wide moats, moats that are durable, moats that will still exist in 10, 20, 30 years. Because here's the thing, a business without a moat will eventually see its profits competed away, competitors will enter, prices will fall, margins will compress, the business will become mediocre. But a business with a strong moat can maintain high returns on capital for decades. It can compound value year after year. It can make you wealthy. So I don't just ask, is this a good business today? I ask, will this still be a great business in 20 years? What protects it from competition? If I can't identify a strong, durable moat, I don't invest. It's that simple. Some of my best investments, Coca-Cola, American Express, Apple, all have incredibly strong moats. Moats that have protected and grown their value for decades. Find the moats. Invest in the moats. That's the second critical strategy. Strategy number 3, concentrated portfolio approach. The third strategy might surprise people. It's concentration, not diversification. Now, I know what they teach in business schools. Diversify. Spread your risk. Own 50, 100, 200 different stocks. I completely disagree with that approach. I think it's wrong. Charlie Munger used to say, diversification is protection against ignorance. It makes little sense if you know what you're doing. And he was absolutely right. Here's my philosophy. If you found a truly great business at a good price, why would you put only 2% or 3% of your portfolio into it? That makes no sense. Instead, you should make it a meaningful position, maybe 10%, 15%, even 20% or more of your portfolio. At Berkshire Hathaway, our top 5 positions often represent 70% or more of our equity portfolio. That's concentrated, very concentrated. Why? Because we've done our homework. We understand these businesses deeply. We're confident in their moats, their management, their future prospects. And when you're that confident, you should bet big, not recklessly, but meaningfully. Think about it logically. If you own 100 stocks, how well can you really understand each one? You can't. It's impossible to deeply research and truly understand 100 different businesses. But if you own 10 or 15 stocks, you can really know them. You can understand their industries, their competitive positions, their management teams, their risks. That deeper knowledge reduces risk. It doesn't increase it. Now, let me be clear. Concentration requires that you're right. You need to do thorough research. You need to understand what you're buying. You need to have a margin of safety. But if you do the work properly, concentration amplifies your returns dramatically. One of my best decisions ever was making Coca-Cola a huge position in the late 1980s. We put over $1 billion into it, which was an enormous position for us at the time. People thought I was crazy. But I understood the business. I understood the moat. I was confident. And that concentrated bet made Berkshire many billions of dollars over the following decades. Here's my advice. Find 5 to 15 truly great businesses. Businesses you deeply understand, businesses with strong moats and good management, then make meaningful investments in them. Don't own 100 mediocre businesses you barely understand. Own a concentrated portfolio of great businesses you know intimately. That's how you build real wealth. Strategy number 4, long-term buy and hold. The fourth strategy is simple but incredibly powerful. Buy and hold for the long term, really long term. My favorite holding period is forever. Actually, forever. When I buy a stock, I'm not thinking about selling it in 6 months or a year or even 5 years. I'm thinking about owning that business for decades, maybe forever. Why? Because that's how compounding works. That's how wealth is truly built. Let me give you a concrete example. We bought Coca-Cola stock in 1988. We paid about $1 billion for a roughly 7% stake in the company. Today, that investment is worth over $25 billion, and we've collected billions more in dividends over the years. But here's the key. We never sold. Not when the stock went up. Not when there were market crashes. Not when people said Coke was overvalued. We just held. And that patience, that long-term perspective, created enormous wealth. If I had sold Coke in 1995 when it doubled, I would have missed out on tens of billions of dollars in additional gains. If I had sold in 2000 during the tech bubble, same thing. But I didn't sell because I wasn't trying to trade. I was owning a business, a great business, that I wanted to own indefinitely. Short-term trading has several massive disadvantages. First, you pay taxes every time you sell at a gain. Those taxes compound negatively over time. Second, You incur transaction costs, commissions, spreads, fees. It's third, and most importantly, you interrupt compounding. Every time you sell and buy something else, you're restarting the compounding process. But when you hold for decades, the gains compound tax deferred. No interruption, no friction, just smooth, continuous compounding. Well, let me give you the math on this. If you have $10,000 and it grows at 10% per year, after 30 years, you'd have about $174,000 if you held the entire time. But if you traded frequently, paying taxes and costs along the way, you might end up with only $80,000 or $90,000. That's half the wealth, just from trading instead of holding. Now, buy and hold doesn't mean buy and ignore. You should monitor your investments. Make sure the fundamentals remain strong. Make sure the moat is intact. Make sure management is competent. But unless something fundamentally changes, you should hold. Let time work for you. Let compounding work its magic. One of the most expensive mistakes investors make is selling too early. They buy a good stock, it goes up 50%, they sell and feel smart, but then they watch it go up another 500% over the next decade without them. Don't make that mistake. When you find a truly great business at a good price, buy it and hold it for decades. That's the fourth critical strategy. Strategy number 5, margin of safety. The fifth strategy is the margin of safety principle. This is absolutely fundamental to protecting your capital. The concept comes from Ben Graham, my teacher and mentor. It's simple but profound. Always insist on a significant gap between the price you pay and the value you're getting. Never pay full price. Never pay fair value. Always demand a discount, a meaningful discount. Why? Because you might be wrong. Your analysis might be flawed. The future might not unfold as you expect. Unexpected things happen. The margin of safety protects you from those errors and uncertainties. Let me give you an example. Suppose you analyze a company and determine it's worth $100 per share. If it's trading at $95, that's not enough of a discount. Too risky. But if it's trading at $60 or $70, now you have a real margin of safety. Even if you're somewhat wrong in your analysis, even if things don't go perfectly, you'll probably still do okay because you bought at a significant discount. The margin of safety principle has saved me from countless bad investments over the years. There were many times I thought a company was worth X, but I wouldn't pay more than 0.6X or 0.7X, so I didn't buy. Later, it turned out the company had problems I hadn't fully appreciated. The value was actually less than I thought, but because I insisted on that margin of safety, I didn't lose money. I simply didn't invest. That's the beauty of this principle. It keeps you out of trouble. It prevents big losses. And in investing, avoiding big losses is just as important as finding big winners, maybe more important. Here's a mathematical reality. If you lose 50% on an investment, you need to make 100% just to get back to even. Losses hurt much more than equivalent gains help. So protecting your downside through a margin of safety is critical. Now, how big should the margin of safety be? That depends on the certainty of your analysis. For a very stable, predictable business that I understand extremely well, maybe I'd accept a 20 to 25% margin of safety. But for a more complex or uncertain business, I'd want 40%, 50%, maybe even more. The less certain you are, the bigger the margin of safety you should demand. This principle also forces discipline. It prevents you from overpaying in moments of excitement or euphoria. It keeps you rational when markets are irrational. I've watched countless investors lose money by paying too much. They found a great company but paid a full or inflated price. And even though the company performed well, they didn't make much money because they overpaid at the start. Don't make that mistake. Always, always insist on a margin of safety. Wait for the right price. Be patient. And when you finally buy with a cushion of safety beneath you. That's the fifth critical strategy. Strategy number 6, quality over quantity. The sixth strategy is prioritizing quality over quantity. And by quality, I mean the quality of the business itself. Early in my career, I was influenced heavily by Ben Graham's approach of buying cheap stocks, cigar butts, he called them. Companies trading below liquidation value, really cheap stuff.
And that worked for a while when I was managing smaller amounts of money. But I learned something important from Charlie Munger. He taught me that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That insight transformed my investing approach, and it's made Berkshire Hathaway enormously successful. Here's why quality matters so much. A wonderful business keeps getting better over time. It compounds value year after year. It can be held forever. But a mediocre business, even if you buy it cheap, stays mediocre. It doesn't compound well. You eventually have to sell it. And selling triggers taxes and requires finding another investment. Let me give you concrete examples. Buying See's Candies in 1972 was a quality investment. We paid $25 million, which seemed like a lot at the time. But it was a wonderful business with an incredible brand moat. Over the following decades, See's generated over $2 billion in cumulative pre-tax earnings for Berkshire, and we never had to invest significant additional capital. The business just kept producing cash, year after year.
That's the power of quality. We paid a fair price for a wonderful business, and it created enormous wealth. Now compare that to many of the cheap stocks I bought early in my career. I'd buy a struggling textile company or a failing retailer because it was statistically cheap, but those businesses didn't get better. They stayed marginal or got worse. I'd make a small profit and move on, constantly searching for the next cheap stock. That approach was exhausting and far less profitable than simply owning quality businesses for decades. So what makes a quality business? Several things. High returns on invested capital. The business generates strong returns on the money invested in it. It doesn't require massive capital expenditures just to maintain its position. Sustainable competitive advantages? We've already talked about moats, but this is where they really matter. Quality businesses have durable moats. Excellent management. Management that's talented, honest, and shareholder-oriented. Management that allocates capital wisely and thinks long-term. Simple business models. Businesses I can understand, not complex financial engineering or industries I don't comprehend. Predictable earnings. Businesses with relatively stable, predictable cash flows, not wildly cyclical or dependent on unpredictable factors. When you find a business with all these quality characteristics, you should be willing to pay a reasonable price for it. Not any price, but a fair price. Because that quality business, if held for decades, will create far more wealth than a dozen mediocre businesses bought cheap. This is why I'm willing to pay up for companies like Apple. Yes, Apple isn't statistically cheap, but the quality of the business, the brand, the ecosystem, the customer loyalty, the financial strength is extraordinary. And that quality justifies a fair price. Maybe even a slightly elevated price. I'd rather own one quality business for 30 years than 10 mediocre businesses for 3 years each. The compounding from quality is just far, far superior. That's the sixth essential strategy. Always prioritize quality over quantity. Strategy. Number 7, circle of competence. The 7th strategy is staying within your circle of competence. This is critically important and often ignored. Your circle of competence is the area of businesses and industries that you truly understand, where you have real knowledge and insight. My circle of competence includes insurance, consumer brands, banking, certain types of retail, and increasingly technology businesses like Apple that have become easier to understand. My circle does not include biotech, complex pharmaceuticals, most technology startups, cryptocurrency, or highly technical industrial processes I don't understand. And here's the key. I don't invest outside my circle. Ever. No matter how attractive something looks. If I don't understand it, I pass. Why? Because if you don't understand a business, you can't accurately value it. You can't assess its risks. You can't judge its competitive position. You're basically gambling. I'll give you an example. During the 1990s tech bubble, everyone was making money in technology stocks. Internet companies with no earnings were going up 500%, 1,000%. People criticized me. Warren's lost his touch. He doesn't get technology. He's missing the biggest opportunity ever. But I didn't understand most of those businesses. I couldn't value them. They were outside my circle of competence. So I didn't invest. And when the bubble burst in 2000 to 2002, most of those companies went to zero. People lost
trillions of dollars. But Berkshire Hathaway, we were fine because we stayed within our circle. Now, I'm not saying technology is bad. I'm saying I didn't understand those specific businesses at that specific time. They were outside my circle. But when I did understand a technology business like Apple in the 2010 S, I invested heavily.
Because by then I understood the business model, the ecosystem, the competitive advantages. It had entered my circle of competence. Here's an important point. Your circle of competence doesn't need to be large, just needs to be well-defined and respected. It's far better to deeply understand 10 industries than to superficially understand 100. You don't need to be an expert in everything. You just need to know what you know, and more importantly, know what you don't know. One of the most dangerous things in investing is thinking you understand something when you actually don't. Overconfidence outside your circle of competence destroys wealth faster than almost anything else. So how do you define and expand your circle of competence? First, be honest about what you truly understand. If you can't explain how a business makes money, what its competitive advantages are, what risks it faces, and why customers choose it over competitors, you don't understand it. Second, stick to simple businesses whenever possible. The simpler the business model, the easier it is to understand and value. Third, expand your circle slowly and carefully. Read, study, learn, but only claim something is within your circle when you really genuinely understand it. Fourth, it's perfectly fine to have a small circle. I've made billions of dollars investing in a relatively small number of industries I understand well. I've never invested in mining companies, pharmaceutical developers, complex technology hardware, or dozens of other industries, and that's completely fine. I don't need to understand everything. I just need to understand enough good businesses to deploy capital effectively, and so do you. Some of the worst investment mistakes happen when people venture outside their circle of competence. They hear a tip, they see something going up, they get FOMO, they invest in something they don't understand, and they lose money, often lots of money. Don't make that mistake. Define your circle, stay within it, be patient, and wait for opportunities inside your circle. There are plenty of good investments within your circle of competence. You don't need to chase things outside it. That's the seventh critical strategy. Know your circle of competence and never ever venture outside it. Strategy number 8, owner mentality. The 8th strategy is adopting an owner mentality. This fundamentally changes how you think about investing. When I buy stock in a company, I don't think of myself as buying a piece of paper that will hopefully go up in price. I think of myself as buying a piece of a business that I now partially own. That might sound like a subtle distinction, but it changes everything. As a part owner of a business, I care about the fundamentals. How much is the business earning? How are those earnings growing? What returns is it generating on invested capital? Is management allocating capital wisely? I don't care about daily stock price fluctuations. I don't care about quarterly earnings, slightly missing analyst estimates. I don't care about short-term market sentiment. I care about the long-term economic performance of the business I now own a piece of. Let me give you an example. When we bought a large stake in Apple, I didn't think, I hope AAPL stock goes up 20% this year. I thought, we now own roughly 5% of one of the greatest businesses in the world. How much value will this business create over the next decade? That's an owner's perspective, and it leads to completely different behavior. An owner doesn't panic when the stock price drops 15% because of temporary bad news. An owner asks, did anything fundamental change about the business? If not, the price drop is actually an opportunity to buy more. An owner doesn't sell just because the stock doubled. An owner asks, is this still a great business? Will it continue creating value? If yes, why would you sell? An owner thinks about intrinsic value per share, not stock price. And there's a big difference. Stock price is what the market says your share is worth today. It fluctuates wildly based on emotions, sentiment, fear, greed. Intrinsic value is what your share of the actual business is worth based on its future cash flows. This changes much more slowly and predictably. As an owner, I focus on intrinsic value. Is it growing? Is management increasing the value of my ownership over time? If yes, I'm happy, even if the stock price temporarily goes down, because I know that over time, stock price and intrinsic value converge. This owner mentality also affects how I evaluate management. I ask, if I owned this entire business, would I want these people running it? Are they competent? Are they honest? Do they think like owners themselves? Do they allocate capital intelligently? Do they prioritize long-term value creation over short-term metrics? If the answer is yes, that's a business I want to own. If the answer is no, I don't care how cheap the stock is. I don't want to be in business with them. The owner mentality also means I think about my portfolio differently. I don't own 50 stocks because I'm trying to trade them. I own 10, 15 businesses because I want to be a part owner of those specific enterprises. Each position represents a meaningful ownership stake in a business I've carefully chosen and deeply understand. This mentality eliminates so many common investing mistakes. You won't day trade because owners don't frantically buy and sell their businesses daily. You won't panic during market crashes because owners focus on business fundamentals, not price. You won't chase hot stocks because owners do careful analysis before becoming partners in any business. You won't over-diversify because you can't be a thoughtful owner of 100 different businesses. Think like an owner, act like an owner, invest like an owner. That's the 8th essential strategy, and it's one of the most important shifts you can make in your investing approach. Strategy number 9, patience and discipline. The 9th and final strategy is patience and discipline. In many ways, this is the hardest strategy to implement, but the most important. Investing is not about activity. It's not about constantly buying and selling. It's not about always being fully invested. It's about waiting for the right opportunities and then acting decisively when they appear. Ted Williams, the great baseball player, once said that the secret to hitting was waiting for the right pitch. He divided the strike zone into 77 different zones and knew his batting average in each one. He would wait and wait for a pitch in his best zone. And when he got it, he'd swing hard. That's exactly how I invest. I wait for the right pitch. I'm not obligated to swing at every opportunity that comes along. I can just watch and wait. Most of the time, I'm not buying anything. I'm just watching, analyzing, learning, waiting for something truly attractive to appear at the right price. And that requires enormous patience. In 2008 to 2009, during the financial crisis, we made several massive investments. Goldman Sachs, General Electric, Bank of America, billions of dollars deployed in a matter of months. But before that crisis, we had spent years building up cash, waiting patiently. People criticized us. Buffett's sitting on too much cash. He's lost his nerve. He's too conservative. But we were waiting for the right pitch. And when the crisis hit, when fear was at its peak, when great companies needed capital, we were ready. That patience was rewarded enormously. Those crisis investments made Berkshire many billions of dollars. Patience means several things in investing. Patience to wait for the right price. Don't overpay just because you want to be invested. Wait for a margin of safety. Wait for fear or temporary problems to create opportunity. Patience to hold for the long term. We've already discussed this, but it bears repeating. Don't sell great businesses just because they've gone up. Hold them for years or decades. Patience to sit on cash. Sometimes there simply aren't good opportunities available. Everything is overvalued. In those times, hold cash and wait. Don't invest just to be invested. Patience to let compounding work. The first few years of compounding feel slow, but over decades it becomes incredibly powerful. You have to be patient enough to let it work. Now let's talk about discipline. Discipline is what allows patience to actually work. Discipline means following your rules even when it's uncomfortable, even when everyone else is making money doing something different, even when you're being criticized. My discipline includes never overpaying. No matter how much I love a business, if the price isn't right, I won't buy. That takes a discipline when you really want to own something. Never investing in what I don't understand. We already discussed circle of competence. Discipline means actually sticking to it when attractive opportunities arise outside your circle. Never panicking. When markets crash and everyone is selling, discipline means staying calm, analyzing rationally, often buying when others are panicking, never following the crowd. Just because everyone else is buying technology stocks or cryptocurrency or whatever the hot trend is, doesn't mean I should. Discipline means thinking independently, never abandoning fundamentals. It's easy to rationalize bad decisions, to convince yourself that this time is different. Discipline means sticking to fundamental principles even when it's tempting not to. Let me tell you about a time when discipline was really tested. In the late 1990s, the internet bubble was inflating. Technology stocks were going up 50%, 100%, 500%. Every day I watched other investors get rich while I sat on the sidelines. The criticism was intense. Buffett doesn't get it. He's too old. He's missed the biggest opportunity ever. It would have been so easy to abandon my discipline, to start buying these stocks I didn't understand just because they were going up. But I didn't. I stuck to my principles. I stayed within my circle of competence. I refused to pay insane prices for businesses I couldn't value. And when the bubble burst, I was vindicated. But more importantly, Berkshire's capital was protected. We didn't lose billions like so many others. That's the power of discipline. It protects you from yourself, from your emotions, from the temptation to do something stupid just because everyone else is doing it. Patience and discipline work together. Patience gives you the time for great opportunities to appear. Discipline ensures you only act on the truly great ones. Together, they're an incredibly powerful combination. Most investors fail, not because they can't find good investments. They fail because they lack patience and discipline. They buy too early, sell too early, chase trends, panic during downturns, and constantly tinker with their portfolios. Don't make those mistakes. Be patient. Be disciplined. Wait for the right opportunities. And when they appear, act decisively with conviction. That's the ninth and final essential strategy, putting it all together. Now let me show you how these 9 strategies work together, because they're not separate ideas, they're interconnected principles that reinforce each other. You start with value investing, buying things worth more than you're paying. You focus on businesses with strong economic moats, sustainable competitive advantages that protect value over time. You build a concentrated portfolio of these high-quality businesses that you deeply understand. You adopt a buy and hold approach, letting compounding work over decades. You always insist on a margin of safety, never overpaying even for great businesses. You prioritize quality over quantity, owning wonderful businesses at fair prices rather than mediocre businesses at cheap prices. You stay strictly within your circle of competence, only investing where you have real understanding. You think like an owner, focusing on business fundamentals rather than stock prices. And you exercise patience and discipline, waiting for the right opportunities and then acting decisively. These 9 strategies together create a powerful, cohesive investment approach. An approach that has worked for me for 75 years. An approach that has built Berkshire Hathaway into one of the most successful companies in history. And here's the beautiful thing. This approach doesn't require genius. It doesn't require special connections or inside information. It doesn't require constant monitoring or complex algorithm. It just requires discipline, patience, and a willingness to think independently and long-term. Anyone can apply these principles. You can apply them whether you have $10,000 or $10 million to invest. The strategies scale. The principles remain the same. Common mistakes to avoid. Before we finish, let me briefly mention some common mistakes I see investors make that violate these strategies. Over-diversification. Owning 50 or 100 stocks because they think it reduces risk. It actually increases risk because you can't possibly understand that many businesses. Short-term trading, trying to make quick profits by trading in and out. This generates taxes and fees and interrupts compounding. Investing in what's hot, buying whatever sector or stock is currently popular without understanding the fundamentals. Ignoring valuation, buying great companies at any price. Even wonderful businesses can be bad investments if you overpay. Panic selling, selling during market downturns out of fear, locking in losses and missing the recovery. Following tips, investing based on what someone else recommends without doing your own analysis. Complexity.
choosing complex investments over simple ones, often leading to investments outside their circle of competence. Impatience, not giving investments time to work, selling too early, always looking for the next thing.
Avoid these mistakes. They're wealth destroyers. Every single one of them violates one or more of the 9 strategies I've outlined. Conclusion and final thoughts. These 9 strategies have guided my investing for over 7 decades. They've worked through bull markets and bear markets, through periods of high inflation and low inflation, through technological revolutions and financial crises. They've worked because they're based on fundamental economic principles that don't change. The importance of value, the power of compounding, the advantage of competitive moats, the wisdom of patience and discipline. These aren't get-rich-quick schemes. They're get-rich-slowly strategies. But slow and steady wealth building is far more reliable than trying to get rich quick. If you apply these 9 strategies consistently and patiently over decades, you will build wealth. I'm absolutely confident in that. You won't become a billionaire overnight.
You won't double your money every year, but you will steadily, reliably build substantial wealth over time. And you'll sleep well at night because you'll own quality businesses that you understand, bought at fair prices, with margins of safety protecting your downside. That's real wealth. That's sustainable wealth. That's the kind of wealth that lasts and can be passed on to future generations. So study these strategies, understand them deeply, and most importantly, apply them with discipline and patience. Your financial future will thank you. If you found this valuable, please like this video and subscribe to the Trading Man channel. We're committed to bringing you investment wisdom that actually works, not hype, not speculation, just proven principles that can change your financial life. Thank you for watching. Invest wisely. Think long term. And remember, the stock market is a device for transferring money from the impatient to the patient. Be patient, be disciplined, be successful.